I love buying stuff that's under rented because it gives you such an opportunity to, there is no way that I've found in property in 15 years in the industry that you can create as much capital value increase as you can by increasing rent.
Yeah.
It almost costs you nothing as long as you have the mechanisms within your lease to allow it.
Yeah.
At a 6%, I don't want to get too technical, but at a 6% capitalization rate, which is, a way that you would value commercial property, every $10,000 in rent is worth 160 grand in value on the property.
Yeah.
So that, if you can increase the rent by $20,000, you just made $300,000 in equity.
Yeah.
And it's cost you nothing.
Welcome to Get Invested on the Property Hub podcast channel, the leading weekly show for Australians who want to learn how to unlock their full self, health and wealth potential. I'm your host, Bushy Martin, and each week I go deep with the best investors, experts, leaders and founders to find out what it takes to break free from the grind, discover freedom and to live by design. Subscribe now and join me and get invested in the life that you really want. Let's get started.
Hi, freedom fighters. Is commercial property right for you and your investment strategy? And if so, how does it work? And how can you secure superior high-performing commercial assets? And what should you buy, where, when, and how? Because commercial property is a completely different kettle of fish to residential property. In fact, it's so different that it's akin to learning a new language while you're in a foreign country. And about the only similarity is that they both generally sit on a block of land and they may share similar building materials. Now, traditionally, as I mentioned last week, most investors start in residential to optimise achievable growth given its relative affordability in order to get on the property investment ladder. And then when their portfolio equity has grown, along with their borrowing capacity, or they're looking to convert from growth to cash flow, they then rationalise and leverage into higher cost and high yielding commercial property. And while cash flow yield is often a primary driver, capital growth is also achievable and can be manufactured if you know what you're doing, where and how best to create it. And if you'd like to explore if and where commercial property might fit best into your property investment strategy and you want to know some more, feel free to book in with me for a personal solution session by clicking the link in the show notes. Because I continue to see growing exponential interest from investors in commercial property. So to add to the series of commercial property buyers agents that we've interviewed here on the Property Hub in the past, and if you haven't listened to them, make sure you check out my chats with Scott O'Neill, Steve Polisi and Mish Daniels. But today we continue on a much deeper dive to open your eyes to the intricacies, vagaries, opportunities and risks that commercial property presents in our ongoing discussion with Simon Borham from Eastview Advisory, whose superior specialist project management and property development skills enables him and his team to create, shape and deliver commercial property outcomes that are way over and above the average general buyer's agency who just buy existing commercial properties. Now, last week, Simon unpacked his considerable corporate career and high-level achievements in the commercial property space. And this week, we're going to deep dive with him to reveal more intricacies on how to be successful in commercial property. So welcome back and let's get invested again, Simon.
Thanks, Bushy. It's great to be back.
Now, Simon, I guess just to reposition it, and for those who haven't listened to last week's segment, why did you establish Eastview Advisory? What does and doesn't it do? And where and why does it do it to set things apart from others?
Yeah, so I worked for Aldi supermarkets and a company called Unilever before that, both sort of global retailers, and did that for about 10, 13 years. And I think through that process, I saw the companies made a significant amount of money in property. Aldi probably shares that adage of McDonald's is that you're not a retailer, you're a real estate company. And that was something that I just, thought was a great wealth creation tool. I've had some success in property personally and, continuing that as a career, but under my own terms, was the motivation to start Eastview. It's been a very enjoyable process so far.
Now, to sort of dig into the weeds a little bit there, what does and doesn't Eastview do from a property perspective, and where and what do you focus on?
So I'd say we're a really good buyer's agency for second-time investors or third-time investors. I don't, particularly the types of strategies and the properties that we buy don't generally suit first-time investors. So, what we don't do is, principal places of residence. We will buy residential property if it's got something cool or unique about it that we can leverage to benefit our clients. But generally buy and hold type investments we won't look at. What we do is commercial property acquisitions and advisory. So we'll act for owner occupiers. Like, owner occupiers are a big part of our business, which is people that have successful businesses that are leasing their premises that want to either convert some of their profits into property. There's some really good and attractive ways that you can do that as a business owner. So we help commercial property. We help commercial property. We help business owners get into commercial property, and we also help investors, particularly investors that are keen to do things differently. Identify properties that have value add potential, and use that to really accelerate their gains.
Yeah, I like it. Are you just restricted to your home base there in Newcastle, or how wide and deep do you run locationally?
For investment stock, we'll look nationally.
Yep.
And to make sure, I think if you're going to buy a tenanted investment and you're going to be an advisor to people looking to buy tenanted investments, then you need to be borderless. It's sometimes the best investments in the country exist in Newcastle where we're based, but a lot of times they're not. And so to give people the right advice, we need to be borderless. For our owner occupier business, we have a foothold in Newcastle and also Sydney. And that's a part of the business that we're, over the next sort of 2 to 3 years, we'll be looking to grow into certainly the Eastern Seaboard capital cities, and maybe even further.
Yeah, okay, no, great. That certainly makes it crystal on what you do and don't do. I want to sort of revert now into the mind of the property investors, because you've had personal experience and worked with a lot of them over the time. Given that, what's your thoughts on the common mistakes that you see investors making, particularly in the commercial property space?
Particularly commercial, and this happens all the time, is if you're buying a property, particularly a tenanted investment, what you're buying is the cash flow. Yeah. You're buying a building, you're buying some land, but what you're paying for really is the cash flow. And if that cash flow is linked to a tenant that doesn't really want to be there, or doesn't have the financial capacity to stay there, then a lot of your investment is going to be, is going to be lost, or can be lost, or certainly paused while you go through that tenant transition period.
Yeah.
And now there's risks associated with anything, right? And you can take, we've bought some great properties with short-term leases because there's opportunities there for upside, and we've understood what the risk or opportunities were there.
Yeah.
But so many people that I've seen buy properties not knowing what the tenant's intentions are, they vacate 2 weeks after they get the keys, and they're left standing there with no cash flow on a quite expensive asset.
Yeah, and it's probably important to reinforce at this point that unlike a resi property where you might have a tenancy vacancy for anywhere between 2 to 4 weeks, we're talking months generally for commercial. Can you sort of put a bit more shape around that for us?
Yeah, absolutely. And it depends on, this is, I guess, another difference with commercial is there's so many differences between the asset classes and then the qualities of assets within those classes. You've got A, B, and C grade offices. I'd much rather at the moment own an A grade office than a C grade office because everyone's moving from C grades to A grades at the moment. So yeah, if you had a C grade office that went vacant, you'd be expecting 12, 24, 36 months vacancy, depending on where you are. Whereas if you've got an A grade asset, maybe it's less, but it's certainly longer than residential.
Yeah, no, well said. There's a lot of instant experts in the commercial property space in recent times because it's become flavour of the month. What's an idea or approach that you hear the so-called experts say that you disagree with?
One of the things that I think, particularly the new players, and this is where, I think if you're going to charge a fee for service and the fee for engaging a buyer's agent, they're generally not cheap. If someone's going to pay you an amount of money to represent them on a purchase, you really need to know what you're doing. And a lot of the time, and that sounds so basic, I know, but a lot of the commercial property value is a function of the rent. If the rent is above the market rate, you are paying more for that property than it's worth. And there was one that was sold up here in Newcastle a couple of weeks ago, with a tenant sold for a 6% yield, which is about right for the market. But the rent was about $50 a square meter over what it should be. So about 30% more than it should be. And in pure terms and how commercial works, they paid 30% too much for that property. Yes, it has a tenant. Yes, it's on a 5-year lease. But it's significantly overvalued. And that's what a lot of the new players aren't, they're coming in and they're thinking tenant investment, great 5-year lease, let's do it. But they're not understanding the fundamentals of the market and how that impacts the value.
That's a very good point, because there is a direct linkage there between rental and value. And that also provides some opportunities, because on the converse side of the equation, if you can secure a property at a below market rent, and then you can lift that rent, then you can also lift the potential value of the property. So I guess it works both ways. Am I right in saying that?
Yeah, that's exactly right. And it's a lot of what we do is, I love buying stuff that's under rented, because it gives you such an opportunity to, there is no way that I've found in property in 15 years in the industry that you can create as much capital value increase as you can by increasing rent. Yeah. It almost costs you nothing, as long as you have the mechanisms within your lease to allow it. Yeah. At a 6%, I don't want to get too technical, but at a 6% capitalization rate, which is, a way that you would value commercial property, every $10,000 in rent is worth $160,000 in value on the property. Yeah. So that, if you can increase the rent by $20,000, you just made $300,000 in equity.
Yeah.
And it's cost you nothing.
Yeah. Love it.
And conversely, you buy property with $20,000 too much rent over the market, you've just paid $300,000 too much for it.
Yeah. So working with someone who really understands what the true rental and true, therefore, market value is pretty important right from the get-go, isn't it?
It is, absolutely. And, you need to know your locations, and you need to know the sub-locations within those locations, and the way that affects by the different class of the asset. If it's an A, B or C grade asset, in a different part of town, it's going to command a completely different rent. And I think to be able to look your clients in the eyes and tell them, to give them good advice, you need to understand those things intimately.
Yeah, spot on. That relativity becomes extremely, and the context becomes extremely important in the overall decision making. Well, we might dive into that a little bit more shortly, but something I would love to expand on. You've used a great expression in some of the readings that I found when I was stalking you on Google, where you classify commercial property as opaque. Can you sort of talk to us a bit more about that, and what does that actually mean for investors?
Look, I think if we just use residential as a comparison, if you're going to buy a 4-bedroom, 2-bathroom home in suburb A, you look for the last 3 or 4 4-bedroom, 2-bathroom homes in suburb A that have sold. You take the average, and you can say that you're probably going to be plus or minus 5% on that is how much that property's worth. Yeah. It is, certainly there's a lot more data available for residential property. And it's a lot more to identify, where fair market value is. Yeah. With commercial property, it's one of the things that's always surprised me about the industry, and because it doesn't sound legal, and it completely is, and it's a very, very much a part of the industry's incentives, which is basically because so much of the value of a commercial property is linked to the rent. Yep. Owners are going to be very reluctant to reduce their rent that they're getting for the property. But in their situation where they're trying to attract a new tenant, they might say, well, how about I give you, a deed of incentive that says, we'll reduce your rent by 20% across the term of the lease. And, certainly in office markets at the moment, you can be getting up to 50%, which means that, if you're signing a $100,000 lease, per year over 5 years, it's $500,000. And they say, we'll give you a 50% incentive. They're giving you $250,000 back somehow. Yeah. And now what they've done is protected the value of their asset by not reducing the rent. But they've given you something back, whether it be a fit out or, a rent abatement period. And the legislation doesn't require that you disclose your incentives within your lease. And so, you can see those things on the top level, but you actually, unless you're in the market, you don't know what's happening, beneath the covers, so to speak.
Yeah, and so an unknown buyer could come in just looking at on the face of what's being presented and not know what's lurking in behind the ducks and drakes that have been manoeuvred to actually create that opportunity. It's a bit interesting.
Yeah, that's right. And, and it's not to say that you can't buy those assets, but you need to know what you're buying, and you need to know, all of the strengths and pitfalls of the asset.
Yeah. Now, just I guess on that, because I know you, like myself, focus as much on the risk as the rewards that you get from property, because if you know what the risks are, you can do something about mitigate them. From your perspective, what are some of the key risks of commercial property, and how can investors best manage those?
Yes, look, certainly the first one is vacancies. And it is one that sort of scares off certainly the new investors when they hear, 6 months vacancy. I can't, we can't afford, the situation where that occurs. And so I think that's, certainly, but there's ways that you mitigate that, right? It's sitting down. We'll sit down with the tenants on anything that we're looking at. Where we'll get access to them. We'll ask them, how do you like the space? Is there anything that annoys you about it? What are your thoughts on the property? Are you planning to stay? And most of the time they're really honest, and they'll give you really good insights and information. Yeah. So a surprise vacancies are, can be a really bad pitfall. Yep. The other one is obviously overpaying. If you go and buy something based on a rent that is overinflated to market, the banks obviously need to insure their risk, so they'll only take security over a portion of the market value. And if you've paid above market value, then that balance is on you to come up with. And it's a very easy trap for people to get into, is when they've paid on above market rent.
Because that's effectively, using an equity or a shares term, you could be hit with a massive margin call very early in the piece, and that could take you out of the game if you don't have the rainy day reserve to cover it.
Yeah, exactly right. I'd say those are the main things are really being informed on what you're buying and what its fair market value is, and understanding the risk associated with the tenant that you're buying. And the market prices those risks in as well. Like if you're buying a McDonald's as a tenant on a 20-year plus 20-year lease, well, you're going to get a 3.5% cap rate on that. If you're buying something that's only got a couple of months left to run on a local operator, the market will price in that risk. But I think it's knowing then how much to price in the risk and what the risk of vacancy is likely to be.
Yeah, which would be a real science, because what that's really saying is you need to understand what's happening in the industry, how the existing tenant compares to the other competition, how well is that business performing, because that's going to give a pretty good indication of the longevity of the lease and the future opportunity, I would have thought. Yeah,
and it's similar to how you look at, how you and an investor would look at a residential purchase potentially, is that you want to have that owner-occupier appeal. You want to know that when you sell the property, that you're going to have the most amount of people lining up to buy it, be investors and owner-occupiers. Commercial similar, you want to make sure that you've got, a range of different businesses or assets that can occupy that property. You want to have owner-occupier appeal, so that if you need to sell it, you may be able to sell it to an investor, to someone that wants to own it, or to a range of businesses that could potentially occupy it. And if you get that right, you're mitigating some of those risks of vacancy.
Yeah, I love it. Now, I know that when we talk due diligence in commercial terms, that takes on a complexity and exercises way beyond what you normally do in the residential sphere. Can you sort of expand on some of the key things that an investor needs to be looking at from a due diligence perspective to, beyond what we've already mentioned, to make sure that they really know what they're buying?
Yeah. So like when I did my uni degree, one of the courses that we did was a commercial property analytics course, which was really helpful. And, it teaches you basically there's 3 ways to value or appraise a commercial property. So you've got the square meter rate, which is looking at the property vacant. If it's 100 square meters and it's $5,000 a square meter, then that's a $5,000 property.
Yeah.
We're looking at the capitalization rate, which is looking at the rent. So, how much is the rent? Divide that by the capitalization rate for the industry. So if it's $100,000 and $60,000 at rent, we want a 6% yield, then we know that that's $1 million property. And then the replacement cost method. So, this thing burnt down or I wanted to build it next door, how much would it cost me to buy the land and build the building?
Yeah.
Now, every time I look at those, that's, I guess, the first step of due diligence to me in looking at any commercial property is, yes, we like the look of it. It ticks a few boxes for us off the bat. The next thing is I do those appraisals across those 3 metrics.
Yeah.
If it doesn't stack up on at least 2 of them, I move it on. We're not interested.
Yeah.
And generally we like to see them, coming in under what we're appraising them as. If we're looking at it and everything's showing us that the property's actually, we could buy it for less than what we think it's worth, that's when we really start to get interested. The next thing I think, like particularly for early stage investors, is understanding what are the square meter rates in your area for rent and for vacant possession. And you need to make sure that you're staying either at the market or under the market. As soon as you're paying above market for rent or above market on the square meter rate, you're likely to end up in a valuation shortfall perspective, which can get really ugly.
Yeah, no, well said. Sort of bring that together then, particularly from a beginning perspective, who is and isn't suited to commercial property investment then, Simon?
Look, I think commercial property, there's a bit of a myth that commercial property doesn't have the same capital growth that residential does. And there's been lots of studies done on it. And the answer is it does. They happen at different times. So I think, I wouldn't say, people who want capital growth shouldn't, invest in commercial, even though it's better known as a rental yield play.
Yeah.
I think it's definitely it's definitely not for first time investors.
Yeah.
I think first time investors that are looking to build a capital base should be in residential. It's lower deposits, lower barriers to entry, lower risk, smaller vacancies, better to get in.
Yep.
Once you've got a bit of a capital base behind you, it can be a very attractive investment.
Yep.
And so, second, third, fourth time investors that have a capital base that are looking to either diversify for income or, starting to convert some of their residentials over to commercial as they're looking to retire or, maybe move out or work less.
Yeah.
It can be really, really attractive because you're going to get a much better yield. You're going to get a much better net yield. So your tenant's paying all of your outgoings, provided the lease is set up correctly. And therein is opportunity to increase and get all the same capital growth, but just at a slightly higher capital base.
Yeah, no, well said. Well, let's put some shape around some of the numbers, I think, because that'll start to get some relativity in people's heads. And some of the key numbers that I'd love you to share is, the sort of price points. I know it's going to differ by sector and location, but from a general perspective, some of the price points, what are some of the net yields? Because the net yield's the important piece, because we know resi's 2 to 3% if you're lucky. In most cases, is the net yield position from that perspective. Can you sort of put some sort of rules of thumb around that so that those listening go, oh, okay, yes, I'm there, or no, I'm not there yet?
Yeah, absolutely. The yields have changed significantly over the last probably 5 years, it was interesting to watch it happen because the interest rates started going up, but the yields went down. And so you got this real compression on your cash flow. Like there was a point in time where you were getting 8% yields in commercial and you were paying 2% in interest. And, that significant cash flow, coming through for properties that are leveraged. So I think as a general rule, you'd be looking at around a 6% return.
Yeah, that's net or gross?
That's net.
Yep.
6% net return. So
still pretty good.
You want to make sure that that's the rent that's coming back to you after your tenants paid all of the outgoings.
Yeah.
So $60,000 worth of rent for every $1 million that you invest.
Yep.
I think it's worth saying that the market, I'd say below $1 million, is hyper saturated at the moment.
Yeah.
There's lots of buyers agents out there. There's lots of mum and dad investors out there. Trying to have a crack, and $1 million seems to be this magic number that everyone's got in their head that they want to buy a property for.
Yeah.
And that's putting pressure on yields.
Of course.
So, people are willing to pay more for that same amount of rent. I personally think that sort of $2.5 to maybe $15 million range is where a lot of the sweet spot is.
Yeah.
The mums and dads have generally, hit their sort of serviceability ceilings at that level, but the institutional investors aren't really that interested below sort of 15 million. So there's some really good opportunities there to get high quality properties, opportunities to add value, but still relatively safe and good yields.
Yeah, no, very well said. And I think that it's the old story. At the lower end, there's going to be a lot more people fighting over the hot chips, and therefore that in itself creates its own issues and challenges. If you're really wanting to lift the bar and get into some clearer air, and you've got the capacity to do 2.5 mil and above, then you're probably more likely to get a high performing asset anyway, I would assume.
Yeah, absolutely. And I think, historically the barriers to entry had been, quite high with commercial. Sort of most banks sort of above $3-4 million want you to have, at least a 35% deposit.
Yeah.
It was historically 30% deposit across the board with commercial.
Yeah.
There's a lot more lenders that are looking more favorably on it. And you'd know this better than anyone that, you're starting to get 80% loans in commercial. A lot of our owner occupier clients are, certainly in that 80% area. And so the barriers to entry are getting lower. You're talking the difference between a 20% and a 30% deposit on $1 million property is $100,000. Like
Exactly.
it's not a lot. It's not an amount of money that most people have just sitting around. So, those barriers to entry reducing, increase competition, but it also means, increases your ability to participate too.
Yeah, exactly. No, that's spot on. So I want to sort of shift gears a little bit into the commercial property buyers agent space for a second, because I think, given everything you just mentioned, the quality of that buyers agent is going to become more and more critical to the outcome of an investor's purchase. What do you think separates a sort of a standout commercial property buyers agent who can help investors secure outperforming assets from the average run of the mill?
Look, I think it comes back to, and the problem is, and this is maybe an industry gripe that I have, is that there's far too few barriers to becoming a buyer's agent. It's a relatively easy license to obtain. You can get some experience working under people that don't necessarily have to have experience to have you working under them. And within a couple of years, you're sort of out there in the wild and have the ability to go out and open your own agency.
Yeah.
And so I think the barriers to entry are really low, and and the restrictions on people deciding that they're no longer a residential buyer's agent, they want to be a commercial buyer's agent, can happen overnight. And it really is concerning, because you're dealing with significant amounts of money, of other people's money, and you're being paid as a professional to be an expert.
Yeah.
And there's no real way to stop you from doing it without being an expert. And that's where I think, a lot of, you sort of mentioned Eastview success, we're only a sort of 18, 20-month old business. And we've grown rapidly. We have staff, we have an office. And a lot of the reason for that is because, myself as the director and licensee, I have I'm dual degree qualified. I've got a business degree. I've got a master's degree in property development. I've got, over 10 years experience doing this for large corporates and being involved in transactions of, up to hundreds of millions of dollars. It's something that I think I've got the benefit of experience, and the benefit of formal qualifications that just unfortunately aren't yet required of buyers agents. And I think, whoever you choose to work with, I think it's really important to look at, what is their track record, get them to show you what they've done and how they've delivered value for other people, but also what qualifies them, to do that.
Yeah, well said. How important are your project management skills and your experience in the property development sphere to your commercial property prowess, do you think, Simon?
Oh, it's certainly a feather in the cap. One of the things, and this maybe sets us apart from other buyers agencies, is the due diligence, as you sort of mentioned before, is very, very cumbersome with commercial property, and you can burn a lot of time in looking at things that you decide, pretty quickly not to. Like our approach is identify a property that we like the look of and then find all the reasons why we shouldn't buy it.
Yeah.
And if it's still there at the end, then there's something pretty special about it.
Yeah.
The way that I look at the project management and development experience in the background is really comes into those value adds. A lot of the buyers agents out there will look for cookie cutter properties. Is there a good tenant on a 5-year lease at a 6% yield at a market rent? Cool, there is, done, get into that.
Yeah.
We'll look at things a little bit differently. What's the ability to add a mezzanine? What's is there a low site coverage? Have we got a 1,000 square meter site with only 200 square meter building? Is there an opportunity to add additional buildings here? We do development feasibilities. I've done 3 this morning, for different clients on undervalued or low site coverage sites. And the ability to do that accurately is, I think there's people out there again that can do it. The ability to do it accurately is incredible. I think it's incredibly hard to do, and it's a skill that adds a lot of value, because anyone who's tried developing a property in the last 5 years will know that it is almost impossible to get something to stack up unless you bought it 10 years ago and you're not in it for much for the land.
Yeah.
Anyone that puts these numbers together and says, oh, look, here's a development with 30% margin, their numbers are wrong.
Yeah.
Yeah. And that's where we come in, because we know that and we can see that accurately.
Yeah, I think the important thing you mentioned there is not only the depth of analysis that you can do on doing that feasibility, but also how quickly you can do it. Because if you're able to do that almost intuitively, given the experience that you bring to the table, and you can knock out properties pretty quickly that you're not going to burn up and waste a lot of time on, so you can then pursue those that do meet the grade, then that's adding pretty significant value to someone who's looking to secure a high-performing commercial asset. So I love that. If we sort of brought that all to a head then, Simon, what do you think are the keys to being a successful commercial property investor?
Look, I think the keys, and it may sound a little bit like chasing unicorns here, but what you want to do is find properties in high quality locations that have either low site coverage or below market rent.
Yeah.
With leases that you understand the risks of, and it may be that it's a short term left to run, but you know that there's some upside on the other side, and trying to find as many of those assets as possible and then never sell them.
Yeah.
I say this to a lot of clients: is you should never buy a property that you intend to sell. The biggest gift I want to give my kids is a tax headache that they're going to have with divesting everything that hopefully we've accumulated for them.
Yeah.
The cost of entry and exit is so high that you just want to make sure that you buy assets you're going to be really happy you bought in 20 years' time.
Yeah.
For me, that's a successful investor.
Yeah, well, 100%. And even as a safety net, if you're going to buy a property, assume you're going to be stuck with it forever. And if it still makes sense, pursue it. If it doesn't, then that's telling you something.
Just let it go.
Yeah, no, love that. Let's jump into the future for a minute. And I don't have a lot of time for property forecasters, because 99.9% of them are wrong. And the more definite they are, the more nervous I get. But given you're playing in this commercial space, what's your read on property investment conditions in the medium term, and where and what do you think are the best investment opportunities in that space?
What the most interesting thing that I think is happening at right now is the cost of new development.
Yeah.
It is so prohibitive to new stock.
Yep.
I mentioned we work with a bunch of owner occupier clients, and we've had clients where they've needed a purpose built facility, and we've said, look, to go and build that, it's going to be worth 10% or 20% less than it cost you to build it by the time it's done, because the market value does not exceed, or the market value does not meet the replacement cost.
Yeah.
And in certain situations they know that, and they've decided to go ahead because there's a bigger opportunity for their business, and that's great, and that's fine as long as they know and they understand.
Yeah.
The biggest thing for me at the moment, and I see it as an opportunity and and something to be cautious of. You can buy buildings now for cheaper than they would cost you to build it, and this is particularly true in office spaces.
Yep.
Where you could be picking up a building for $5-10 million less than it would cost you to rebuild the exact same thing. And there has to be an opportunity there in that if people aren't building things because there's no profit in there, that holding those assets that you can buy for cheaper than they cost to replace has to yield a good outcome in the future.
Totally.
So maybe you wouldn't, choose your sector, and maybe you wouldn't look at the office market. But some people with the funds to invest counter-cyclically, I think, will do incredibly well. And Gina Reinhart's buying office towers all over Brisbane at the moment. What do they know that we don't?
Yeah. Yeah, exactly right. And it creates, as you say, a future opportunity, because there's going to be some drag along there at some point where there's going to be a need to add to commercial stock that's costing more than existing stuff. And that's automatically going to put upward pressure on the value of existing properties if they're the right quality.
That has to.
Yeah, no, I love your thoughts on that. Another area, if we're talking about the future, that I know you've got as much interest in as I do, is how do you see AI changing the property industry moving forward, Simon?
AI is going to be really interesting. I've actually spent a lot of time thinking about this. I'm actually in the process of building a property management business that runs off AI, because I think that there's a big opportunity in that space.
Yep.
The way that I think it impacts, say, if we're looking at commercial property businesses, they are so relationship focused. Putting a willing buyer and a willing seller together, I don't think can ever be replaced by a machine.
Yep.
There's too much emotion, nuance, items to negotiate, that needs to be done by people.
Yep.
I think for me, and I'm in, I've invested some money actually in this at the moment, is building some analytics tools to help with our due diligence.
Yep.
Because there's a lot of things that we do on a repeated basis that I think you could train AI to do. Yep. Or at least, point out and, pick up objects. As an example, I've created a due diligence, GPT, and I can put a contract in there and say, search for a break clause, and it'll read a 160-page contract in 3 seconds and tell me whether there is one or not. And then I've gone and tested it, and so far it's been 100% accurate. So, the due diligence there, I think, is important. I'd love to see it become better with the financial modeling. I'd love it to be able to tell me that, is this square meter rate at market or not? And, if it is, is that right for A, B, and C grade buildings? So it's not there yet, but I think it will be.
Yeah.
And I think that that's, going to be a tool to assist in making better decisions. Yeah. But I don't think it will ever replace the personal nature of getting a transaction done. Because identifying what you want to buy is one thing. Being able to then negotiate that successfully to get an outcome is a completely different skill.
100% agree. And just on that, again, this is an area that I know that you're hot on, and something that I think is really important is the negotiation skills piece. Talk to us a little bit about the importance of negotiation and perhaps your approach to negotiation versus what a lot of other people do.
Yeah, the biggest problem that I find in negotiations is so many people just want to walk in and just screw the other person over. And it is, maybe it works 1 out of 10 times or 1 out of 100 times. If you've got an absolutely desperate person on the other end of the line, what it does most of the time is annoys them and makes them want to go deal with someone else.
Yeah.
And so my approach to negotiation is a few things. Number one, you always want to be prepared. So you need to know the market, and you need to know that most sellers are going to have a range of what I think it's worth. Most of the time it's more than it's worth, because that's a buyer, and as a seller, and most of the time as a buyer, you think it's worth less.
Yeah.
But you need to know where the point that you're going to annoy them is, and what's just a stupid lowball offer that's going to be ignored.
Yeah.
And that's understanding the market. So, offer them the lowest amount you can without getting them offside is the first step. Yeah. The second step is to really understand, price is a barrier, and everyone always focuses on price. But what are the other things in this deal that are important to you? And spending that time listening. Most people spend too much time talking in a negotiation. You need to listen, understand what the other person's saying, because there may be things that you can give them that aren't price related, but that mean more to them.
Yeah.
And as an example, some people need to move things on really quickly. We did a deal a month ago that we negotiated a 2-week settlement, and we took 50 grand off the price for that. But we'll settle in 2 weeks, but you got to drop 50 grand, done deal. So it's understanding what levers you have in the negotiation and using them. And then one of the best tricks that I've ever been taught was never give something away without getting something in return. If I do this, if I can get you an extra 10 or 20 grand on the purchase price, what can you give me? Can I get an extra couple of weeks in settlement? Can I get you to sign a new lease, for the tenant that's going to give me a lot more security? What can I get back for what you're asking for? And really, I have a legal and moral obligation as a buyer's agent to get the best outcome for our clients. And that's what we'll always look to do. But I think if you can negotiate from a perspective of trying to get a win-win for everyone, 9 times out of 10, you walk out in front.
Yeah, totally. 100%. No, well said. I guess to wrap a bow around this, what are the key takeaways that we need to take on board in relation to commercial property investment then, Simon?
Look, I think be cautious with commercial property, but not to the point of avoidance. Commercial property is an amazing asset class, and it really, depending on where you are with your situation, it could really benefit you. Whether you're a business owner that's looking to, park some of the profits from their business, where you control the tenant, is an excellent thing. We own and operate out of the commercial properties that Eastview runs. Yeah. So don't be cautious, but not to the point of not taking action. Yeah. And I think speak to experts. If there's things that you don't know, sit down, have a conversation, increase your knowledge, because you might find that it's not as scary as you think. And as long as the risks are managed, there's some incredibly good opportunities, every week in commercial.
Yeah, I love it. Now, I'm going to resume the old blindfold and cigarette routine and put you into ambush take 2. First of those, mate, what's your favourite quote and why?
My favourite quote? I've got a few. I rattled one off in the last episode that I'm sort of regretting having already used, but I think, for me, it's focus. There's an old Chinese proverb, the person who chases 2 rabbits catches neither. And so, I think that's true with business. I think it's true with life, that if you make a decision to do something, make the decision and go all in. And, once you've completed that, move on to the next thing. Yeah. Don't try and do 10 things at once, because you just do none of them well.
No, beautifully said. Now, moving into both the literary and the podcast world, what's either the top book that you recommend we read, or the top podcast you think we should have a listen to, and why?
Well, this one's probably been done to death, but Good to Great, the book.
Yeah.
I read that I read that when I was an employee, and it rings as much true as an employee as it does a business owner. And I think, there's some really general life lessons in there. One of the chapters is first who, then what, and it just talks about building a great team around you. And then it talks about being on the bus and getting the right people on the bus and the wrong people off it, and doing that quickly. So, I think there's some really good metaphors for life in there, but certainly some good ones for business and for employees.
100%. It's a timeless classic, which the business I've been personally involved in building, that's been a baseline text that we've used to try and shape the business and breed a culture that is sustainable. So I love that. Completely different subject. If I was to give you $50 million in cold hard cash right here, right now, what would you invest it in or spend it on, and why?
Mate, I'd probably I wouldn't have to talk to the banks as much to try and finish our development at the farm. So that'd be pretty handy. I'd certainly see that project through to fruition. Then whatever was left, or hopefully I'd turn that 50 into a bit more once the farm's done. And I would honestly buy a bunch of blue chip commercial assets with, national tenants, maybe some childcare and KFC, maybe an Aldi, back to my old stomping ground. Yeah. I'd get in my caravan and I'd reap the rewards of a really nice, steady cash flow while seeing the country with my family.
Love it. Last question of the 4. If you could wave a magic wand and change anything, what would you change about commercial property investment?
Oh, mate, high barriers to entry for buyers agents.
Yeah.
I think that for two reasons. One, it'd probably help our business kick along a little bit, but two, I think it would mean that the consumers out there are going to be actually getting what they pay for.
100%. Yeah, it's. I've used the expression a bit lately, but the old property Pied Pipers that are leading the unbeknown investors off the cliff just through poor advice is a bit scary for me. Yeah, and that's in resi, lesser degree commercial, but in the resi space in particular, there's some scary stuff happening in that regard. But I don't want to get on my soapbox. Last question, Simon. If I ask you to get invested, what does that mean to you?
Look, for me, I think it's really about understanding how much heavy lifting time is going to do in your life, and that taking action now, even if it's a small piece of action, in 20 or 30 years' time is going to look, you're going to look back and be quite happy. And there's a really good mentor of mine once said that, people used to call him crazy for taking the risks that he took in, buying the properties that he did. And 30 years on, those same people just call him lucky.
Yeah, how true is that? How true is that?
Yeah.
No, that's a really good example. I know you've got a call to action for Get Invested listeners. Do you want to sort of share with us what you've got in mind there?
Yeah, absolutely. Like I love talking about commercial property, and we love that. We sort of talking about that with anyone, particularly people that are looking to purchase. So, what we want to offer any of your listeners is a 30-minute no obligation call. Commercial property is not for everyone, so we'll sort of base that call to see whether we think it's for you. So as I said, no obligation, free conversation, confidential. And we can sort of help you work out whether commercial property is the right asset for you, and if not, which way you might be better off going. So if that's something you're interested in, please send us an email at info@eastview.au. And for your listeners or anyone that sort of mentions the podcast, I'll make sure that I do those calls personally.
Brilliant. Well, we'll make sure we've got all the details on the show notes, and we'll forward them in that direction. And as you've said, it's going to cost you nothing to find out, but invest in some knowledge to put yourself in that position. So, and I'm all about, just like you are, people taking action rather than talking about it. So here's an opportunity to actually do something to further your knowledge. So make sure that you take advantage of Simon's very generous offer there. Mate, thanks again for taking the time to inspire and educate us on all the intricacies, risks and opportunities that commercial property investment presents over the last 2 episodes, Simon. Before we close, if anyone listening needs to help with anything to ensure that everything being offered to you by others is truly in your best interests, and that you're learning and educating yourself on what to do and when, our Know How Property team can now provide you with a quite unique, as and when required, investor protection and validation service, where we sit on your side of the table purely as your expert eyes, ears, arms and legs, and become your independent property protectors, your secret service agents and your guide dogs, in order to keep everyone on your property team honest as your John West of property, where it's the properties, areas and information that we reject, to make sure you get the best to suit your specific situation, as we don't find or sell properties, but we sit beside you independently to vet information, areas and validate properties being suggested by buyers, agents and others, or those that you find yourself, by running independent second-level detailed macro, micro and micro due diligence and holding cost affordability analysis to ensure that a property, a location or a suggestion is truly the best fit to satisfy your specific strategy needs, capacity and comfort level. If this is of interest and you want to know more, just click the link in the show notes to check it out. And that brings us to the end of another great episode. So thanks again for getting invested, and let's make sure we keep the conversation going, Simon.
Thanks, Bushy. Thanks for having me.
Thanks for tuning in to Get Invested on the Property Hub podcast channel, your home for property investment insights and inspiration. Make sure you subscribe to Property Hub for free. Get your weekly dose of Get Invested inspiration along with every episode of Realty Talk, Australia's top online property show for red-hot property investing news and insights direct from industry leaders and influencers. And finally, I'll see you next time.